Okay, so right now we're going to go over the dividend gross up and the dividend tax credit and basically why we do those things. So right now we have a T5 slip statement of investment income, which I guess is what you get if you get dividends. So over here we have the actual amount of eligible dividends, and this is like the actual money that you're getting. And then over here we have the taxable amount of eligible dividends. That's the amount with the gross up. So basically is 31.38 times the actual amount over here. And then over here we have the dividend tax credit for eligible dividends. This would just be like whatever the tax credit is. So this first row is for eligible dividends, and the bottom row is for non-eligible dividends. It's sort of just the same thing that I get. Okay, over here, so the taxable amount is basically the gross up amount. And why we do this is because we want to find out how much the corporation could have paid me in dividends if they didn't have to pay corporate taxes. So it's basically like finding out their income or their sort of like the amount of money that they would need in order to pay me those dividends, sort of. So we're going to go over a little income statement. So in our income statement, we have some revenues, we have some expenses, we get to some net income, and then, oh my God, we pay tax on it, blah, blah, blah. And then now we have our net income after taxes. So now for our retained earnings is made up of our opening retained earnings, and then we add in the net income. So we have this like retained earnings box. The net income goes inside, and then we take out the dividends, okay? And then that becomes our ending retained earnings. And think about the net income that we put in is that this net income is a net income that's after tax. Because you can only like if I have like net income of like, I don't know, $30,000 and I have to pay tax of like $15,000, right? Then I only have like net income of $15,000 after I've paid out all my taxes. So I can't really go to my investors and be like, hey, I'm gonna give you like a $20,000 dividend because I only have $15,000 in cash after I pay the taxes. It's not the 30,000, it's the 15,000. So that what I'm trying to say is that the net income that goes into here is the after tax amount. And this is sort of like the net income this is like sort of the box that I get my dividends from. So my dividends comes from a little box that is made up of after tax amounts. Okay? This is all after tax amounts. So the thing about the after tax amount is that the sad thing, I guess sad thing for like people and businesses, not really for government, is that the what is it? The business? The tax? Right. So the sad thing is that you know how normally if we have like expenses, so we have like a couple expenses here, this reduces our net income, which reduces the amount of tax that we have to pay. Thing is, when we pay out dividends, dividends does not affect our taxes paid at all. Like as a corporation, like if I'm a corporation, the dividends that I pay out to my people, they're not like an expense over here, so they don't really reduce my net income or anything like that. So basically, I'm still paying tax on that. I feel like this is sort of like a topic that I should have said before, but I'm not paying tax on that, which really sucks because that means that like I'm paying out. Oh wait, no, actually, never mind. It's not really that bad. I'm just trying to say that the dividends that you pay out, these dividends, you've like the all the money that you have, you've already paid tax on it, and the dividends don't really reduce the taxes. So basically, you're paying tax on the dividends when you like whatever you do with them, like as a corporation. Okay, so we have that over there. Another thing is, so on my tax return, on a human person's tax return, we have all our 3B, 3B, blah, blah, blah. One of the things that we have is dividend income. And this dividend income is going to be the before tax amount, which is why we have to get the dividend and multiply it by 1.38 to find out what this sort of this net income or like this sort of amount here, like what amount of dividends they would have had to have here in order to pay out that dividend. So what is the before tax sort of earnings that they would need in order to pay out the dividend? And you might be like, well, why do we need to find out this before tax amount? Well, the thing is, you know how if we have like normal like salary stuff like that, it's gonna be like the before tax amount. Like on my tax return, if I have a thing called salary, like employment income, whatever, I'm not gonna be like, oh, like after I've deducted all the taxes, it's $90,000. No, it's gonna be before. I can't like all three deduct the tax and then add in. It's gonna be all like before tax, like the large amounts. So even though in terms of like the money that I'm getting, like it's a corporation that pays the taxes and stuff like that, there's all that stuff. The dividend that I have to report has to be the before tax amount. So I have to multiply it by 0.38. I mean 1.38. Because like the tax rate is like 0.38. So if you do 100 times 1.38, I mean if you do 100 times 0.38, that's the taxes that the company would have to pay, which means that the amount of money that they would have to pay out is, I feel like I'm doing this wrong actually, was 38 plus 100? Won't be that big though. It's gotta be less. This is the dividend that they're paying out to me. This is the before tax amount. This is the dividend that they're, okay, whatever. Oh wait, no, I guess this number would be 138 times 0.38. Okay, so basically I did a bit of math here. I tried to do like a little example. So I feel like I did the math a bit wrong. And if I did it right, I feel like it would all come together nicely. But anyway, going back to this, the gist is we want to find out the before tax amount because putting down the after tax amount is kind of, wrong. Like that's kind of weird. Don't do that. So now I put down by my before tax dividend income here, all my other expenses, salary, net income, blah, blah, blah. And then now one thing is you might be like, okay, so the company pays taxes and then I also pay taxes, but I'm paying taxes on like a before amount, so this is literally even higher. Like how much money is the corporation? Oh my God. Oh my God. Okay. So you might be like, how much money is the government getting? Like they're getting so much money. And well, that's why there's this dividend tax credit. So this dividend tax credit is basically the dividend gross up times 0.38 times, oh, I guess the dividend gross up times 6 over 11. So this thing basically reduces the gross up. So you can sort of imagine that the gross up thing that we do, the multiplying it by 1.38, gets canceled by this dividend tax credit. So at the end of the day, there isn't like additional tax being paid, it's only the normal tax. Now, still one thing to note is that the dividends are being taxed two times. One at the, like, one by the corporation, like when they're doing like their net income stuff, and one by us when we have like our regular dividend income stuff. But like that's fine because there's like some relationships like primary owner or like secondary relationship, I don't know, something like that. And it's fine for it to be taxed twice because the government loves money. So yeah, so basically the gist of the dividend gross up is to report the before tax amount, like even on the what amount of before tax amount even the company had. So yeah, that's that. Blah blah blah. Yeah, so we want to show the before tax on the return because showing after tax is like putting down an after tax salary. So you gotta put down the number before any taxes are paid. Is this it? I think so. Yes. One thing is I try to do like a little thing by like comparing like if money was paid out as a salary versus if they're paid out as like a dividend. But apparently that's not like a good thing to compare because it doesn't really make sense. So we're not gonna do that. So that's it, guys.